Welcome to the daily update, where I'll go over the action in the market for Friday, April 26th, and then we'll see how things look for Monday, April 29th. Saw a pretty solid up day. This was mainly on the back of some earnings reports, specifically with Microsoft and Google. They really helped to push things higher. Intel also had earnings come out, but they weren't all that well accepted, and they ended up falling. And it used to be that Intel was the big player when it came to semiconductors. Now you see other companies like NVIDIA being more into the mix, and even AMD, which used to be like a step behind Intel along the way. Now they're more of a market leader. Anyway, so we did have a higher close, and it was pretty positive. But some of the positive areas that we've been latching onto actually showed some weakness on Friday. Now, I'm not a doom and gloomer, and I'm not a perma optimist either, but I tend to focus on negative things when we're going up, and I tend to focus on positive things when we're going down. For years and years, the big skill that I needed to develop myself is getting caught off guard, having things fly in from left field that I wasn't expecting. That's why I look at so many different charts and I look at all the different markets that I can. I want to know what's going on so that I'm not struck by something that I wasn't expecting. But that's a philosophy that I've developed over the years, as opposed to, hey, just, analysis paralysis, baby. Just give me a few indicators to look at and I can reach a conclusion and tell me what to do, and then I'll go do it. No, I've developed my own philosophy that I like to then share with other people to just make more educated decisions when it comes to what's going on in the market. But Friday was a pretty positive day, and we had the core PCE report came out. That was as expected. But we're wondering, okay, what's going to happen in the upcoming week? We have some major economic reports coming out. We have the ISM manufacturing and non-manufacturing reports. Those are big. And then on Friday, we'll get the employment situation report. Is that going to change our overall scenario going forward from here? I've adjusted it just a little bit that you'll see here in just a moment. So let's go back and talk about what happened, and then I'll go through the charts after that. Right at the open, we had a gap higher open above R1 at 5,074, and prices climbed up to R2 at 5,099. Now you could say 5,100 because that's a round number. The financial media loves to tack onto that. There's a lot of strike prices there for different options, whether they're calls or puts that are suddenly going to go in the money that were out of the money and vice versa. But we did hit that. But then also notice that we hit resistance at that 5110 level. This has been an area for months that I've been talking about. Now, we would eventually get above that later in the day, but then we came down below it as we got into the close. But this is a real long-term line that the market really needs to clear to get back and look even more positive. As the day went on, prices chopped sideways, and then we did go above 5110, but then we fell back below 5110 and closed at R2. We were up 1.02%. So no matter what our indicators are saying, price is the ultimate indicator. And so we have to go with that. But we were below average with volume. That's a bit of a concern to see a solid day, but volume dropping off. Just a bit of a warning sign there. We are still negative, believe it or not. We are negative in the short and intermediate term. Now we're improving and things are starting to look better, but when you take it all together, we still have to maintain more of a negative stance in the short and intermediate term. We're still positive in the long term. And it'll continue to be about inflation and interest rates. And interest rates, now they were down on Friday, but they continue to go up overall. The market is concerned about that. Inflation, well, we had the GDP report on Thursday, which was weaker than expected as far as the report, but stronger than expected as far as inflation. And then on Friday, we had the core PCE, which came in as expected. So again, we have to watch this scenario unfold. And a lot of the doom and gloomers, I kind of go through Twitter and look at different things. And there are a few doom and gloomers that I pay attention to, and they're just stagflation, stagflation, stagflation. Yeah, and that may end up happening. But to try to declare that right now after one report that we saw in GDP, I mean, we've been watching the stagflation scenario for the last couple of years, at least I have, to say and to declare that that's what's going to happen. It's too early to do that right now. We need to see things unfold instead of making a stand right now and then saying, okay, this is the way things are going to be. No, this is a story that unfolds that we have to try to interpret every day that it plays out. And we want to keep an eye on the geopolitical concerns, not only in the Middle East, but now that we hit the weekend, are there going to be more protests going on across the US? Now, that won't really affect the stock market, but it can affect everybody's daily lives. And if things are getting a little more crazy, that, people might be more inclined to sell stock on Monday rather than buy it. Some comments that we can make. We're just below 5,100 right now. So that it's a round number that really isn't technically important. It's more psychologically important. And if we can get back above 5,100, the financial media loves to report this. And it just makes people feel better if you can say, yeah, we're back above 5,100 again. Google and Microsoft had really strong earnings reports. We saw the future strong right after the close on Thursday. That carried through. Europe had a good day, and then we saw that carry over into the open. And we didn't really see any selling into strength. So that's positive as well. Intel, which used to be the main flyer when it came to semiconductors, their earnings were weak, and that stock ended up being down. Oil rose up to $83.85. And on a short-term basis, all of the other things that we've been watching, they're off the list now. The only thing that's still extreme negative is the slope oscillator, and now it's starting to cross above its moving average. And in the long term, we're still looking strong. We have our 150 and 200 period simple moving averages. Those are still extreme positive. And I changed this around just a little bit, where I said the Fed may likely be done. Now I say they might be done raising rates, and now we're wondering, are there even going to be any rate cuts in 2024? And that could throw, as I pointed out yesterday, some of these small banks into a real bad situation, because a lot of these smaller banks that have commercial real estate loans and they have bonds and debt that is going to mature, they thought, well, okay, it won't be, if we have to roll that over, the Fed's going to come in and cut interest rates anyway. So they weren't really worried about it. Well, if the Fed doesn't cut interest rates, that could change the whole scenario around there. The dollar was up and interest rates were lower. We closed at 4.67% for the 10-year yield, where we had been at 4.71%. We're still inverted with the yield curves. Sentiment ticked up. We had been at 40. We came up to 42. Now we're still negative for sentiment, but it is showing some improvement. And we're negative when we look at our trend. The red line is still on top. The ADX is still above its moving average, and both are above 20. With the up day, our bias is positive, and I'm still keeping our momentum at mixed until we really show some strength there. Yeah, we had a fairly good week for the market, but last week was just awful. And when you take it together, we're not out of the woods yet. At least when you look at all the charts, that's the picture that I'm getting here. The economic reports that came out, personal income came in as expected, being up 0.5% and up from the 0.3% we saw last time. Where spending was up 0.8%, more than the 0.6% they had expected, and the same as what we saw last time. The PCE prices came in as expected, up 0.3%, and the same as what we saw last time. This is the big one. The core PCE prices was up 0.3% as expected, and the same as what we saw last time. Consumer sentiment, the final reading, it ticked down a little bit to 77.2, where it had been at 77.9 when we had the preliminary reading 2 weeks ago. And that's what they expected. So it just ticked down a little bit there. Here are some charts. Personal income and spending on a year-over-year basis. We're seeing where spending is going up, but income is pretty much flattening out year over year. And this is a big one with inflation that the Fed likes to look at. On a year-over-year basis, we are continuing to decline here, even though we're flattening out, since the report was pretty much the same as what we saw last month. We want to see this continue to go. The Fed wants to get it down to this 2% level. And so we'll have to see. If we stay above 2%, but we're not really going up with inflation and interest rates kind of stabilize out a little bit, that's more of a no landing scenario. Where a soft landing would be that we saw some economic weakness. We're going to be able to drop down as far as inflation and interest rates without going into a recession. Then a hard landing would be if we actually go into a recession. Then here's the month over month spending where it did tick up and it's been a little bit higher now. And here's consumer sentiment. First, we look at the blue line where it ticked down. That's the total reading. And then the expectations, that's going forward. That's the yellow line. And then how are people feeling right now? A little more pessimistic. And then I have our chart to show you a little bit later. You might want to pause and look at this. This is just taking sentiment by looking at the VIX compared with the S&P, going back to 2005, and then different things that were happening and what the VIX was doing and what sentiment was like at that time. This will give you some historical context. Then we look at what about selling May in an election year? Depending on how you calculate these numbers, with the Stock Traders Almanac, yeah, we might have an up month, but the returns tend to be rather minuscule, up 0.1% during an election year. But if we look at Carson, we're up 77.8% of the time, which is about the same as what Stock Traders Almanac comes up with. But they have a return of 2.3% during an election year. So these numbers can be rearranged around to come up with slightly different results. And then looking at leveraged ETF trading. Now, what we have the SPY. That's a one-to-one relationship, or it's supposed to be. Sometimes it gets a little bit out of line. So if the S&P goes up 1%, the SPY goes up 1%. If the S&P goes down 1%, the SPY. Okay, let me say that again. If the S&P goes down 1%, the SPY goes down 1%. Now we also have what are called leveraged or juiced ETFs, where if the S&P goes up 1%, there are ETFs out there that go up 2 or even 3%. And that's what folks really like to focus on. They think about, oh, look at all this money I can make. Not realizing that if you're wrong, you're going to be 2 to 3 times wrong if you're not correct about that. So you can lose pretty quickly with those kinds of funds. And there are also inverse ETFs that we have available. Some folks tend to prefer using put options instead, but we do have inverse ETFs where if the S&P goes down 1%, there are inverse ETFs that go up 1%, and then there are juiced inverse ETFs, and I said it wrong in yesterday's video, where it may go up 2 or 3%. Again, not focusing as much on what happens when you're wrong on those types of investments. But this just shows, and this tends to go with what the market is doing. When the market's going up, folks tend to prefer the leveraged long ETFs, which that's buy low and sell high. When we're going down, that's when they prefer the short ETFs. Then looking at the median S&P performance since 2000, and we did see 6 consecutive declines. Well, what happened over the next 6 months going forward? Yeah, there's some choppiness along the way, but typically, if you look at the beginning all the way to the end of this chart, we tend to be positive, even if we have 6 days of consecutive declines. And then by the end of 2024, what do people feel is going to be happening as far as the U.S. economy? The no landing, which I talked about. No recession. Inflation still likely to remain above the target, which for the Fed is at 2%. That's what most people think we're going to have. Then you have a soft landing, no recession, and we're headed back down to that 2%. And then there's 17% that are thinking that we're going to actually go into a recession. And strong nominal GDP, surprise if earnings per share can't surprise to the upside. This is just showing the GDP report that came out on Thursday, how it's been going up. And the hope is that the earnings in companies are also going to continue to go up. Here's some Twitter charts. Japan owns the most U.S. treasuries, and that's why we keep an eye on Japan and what's going on there. Of course, the U.S. owns a lot of them, and then China is a big holder of U.S. debt or U.S. Treasury securities. But that's been really dropping off lately. I don't know if that's a good thing or a bad thing. And there was even some commercials a few years ago because China was buying all our debt, and they projected ahead into the future, and It says, the US used to tell us what to do and how to do how to manage our economy. Now we own them because they were buying all of our debt at that time. And if the US can't pay up, well, that basically allows China to pretty much control the US. And it was just a TV commercial. You don't see it much anymore, but lately we've been seeing this really dropping off. It'd be interesting to see where Japan is at since they hold the most treasuries. And then this is another area that we're keeping an eye on. These are the California banks that have commercial real estate. Who's exposed the most? Remember, we had the Silicon Valley Bank and the Republic Bank. And then just a few months ago, there was a New York Community Bank. We're wondering if there's still more shoes to drop with that whole thing. If things really do start to turn and go negative, California has the most amount of risk. And then here's the other states just listed along that have more exposure to commercial real estate loans. And then retail investors. Now, this was before we saw the nice little upward move on Friday. But if the market's going up, people think the stock market is great. If the market's going down, they're more pessimistic about that. So as we have been going down through this latest wave, folks are not as positive about getting into the stock market because most people, they go long in the market. They don't even consider taking advantage of the market when it's going down or sideways. They just want to buy low and sell high. And then here's Bill Gross. He's been around a long time. He's kind of the bond king. He's with a different company now. Does it say here? He used to be with PIMCO, and that's kind of where he made his name. He's with a different company now, I believe. But he just says stick to value stocks. And this is, again, we don't really know how this is going to play out. I've been kind of just playing with this scenario that maybe the market is getting a little bit more defensive now because we're coming into a period of weak seasonality during an election year. And maybe that's what the smart money is doing. And they're having a tendency to get more into value stocks. Now, Friday's session kind of throws that scenario into doubt, but we'll have to see in the upcoming week if that's going to start switching back over. And he says, avoid tech as U.S. yields soar. And, it makes sense. But this is a guy that a lot of people pay attention to. And so they tend to base their decisions around what he says, just like some other CEOs. And then Lance Roberts from Real Investment Advice, he comes up with this chart here and he says, and this is more positive. He says there's almost $1 trillion on Miss Yellen's, the lady with the angelic voice, on the balance sheet, which is about to flow out starting next Monday. That will add significantly to overall liquidity. And we've looked at some liquidity charts recently, and when that goes up, the stock market tends to go up. When that goes down, the stock market tends to go down. And here's our cycles, and I tried to watch his latest video, and he uses all these convoluted cycles, and then he starts talking about when Jupiter aligns with Mars, and it's like the song Aquarius, and I just end up stop watching the video. So this is something that have been trying out to see if there's anything to this, and I'm very skeptical of the whole thing overall. Here's our intraday chart where we gapped up higher. We actually opened above R1. We worked our way up to R2. Do you see this little tick up right here where I'm circling with the cursor? That's the 5110 level. And we hit that and came back down. But later on, we were able to get above it, at least for a while, and then we dropped below. Then we got above it again, and then we dropped down, and we closed just about at 5100 on the day. Intraday, where we saw pretty much all the gains right after the market closed. And that's what we've been seeing lately. We saw the downward move and then the upward move. And then, so we didn't really see all that much strength during the session itself. It pretty much came right after the earnings report came out. And then the futures stayed strong. We did go up a little bit from there. And then we're kind of going sideways as it closes for the weekend. This is more positive. From what we've been seeing lately, the blue line is now above the red line. That means that on an intraday basis, large cap growth is outperforming large cap value. And we did see a nice little move up here because you have Google and Microsoft, they're growth stocks. So when they're going up, and then we saw this sympathy rally with them. So we did see some improvement with growth to value, but we still have some damage that has been done that's left to repair. Our end of day charts growth was up, where value ended up actually being down. And it was up more with the mid caps and up more with the small caps when compared to value. So our end of day chart, we ticked up with small cap growth to value, but we're not just busting out to the upside. Also saw a little bit of a tick up here with the mid caps, but not breaking out, and a little bit of a tick up here going into the lower end of this range that we've been in when we look at S&P growth to value on a ratio basis. This is still holding up, and this is still more positive, where we saw this growth to value ratio come all the way down to the 250 period moving average, and so far it's been bouncing up off of that and going up further into the rainbow. It's not turned back positive yet, but it's holding up for right now. We did see a little bit of an improvement with discretionary to staples. That's the ratio on the bottom that we follow. We came down to the 200-day moving average, and we've been bouncing up from that, but we're not turning back positive yet. Large cap growth came right up to its 50-day moving average. Now that's acting as potential overhead resistance, where after Thursday, we opened at the 100 period moving average and then closed well up off of that. Now we're dealing with the 50 period moving average. The Wilshire ended up being up just about a percent, but we're still below the 50-day moving average. And here's our trend. The red line is coming down, but it's on top, and we're rolling over a bit, but we're still above the moving average. Another strong day or two, and we could see this cross below. If we see some real strength in the market, we might see the green line actually be able to come over, take the red line, but we're not seeing that yet. And we're seeing kind of that same thing here on the short-term chart for our average directional movement. We did come down just a little bit. We'd spent the last couple of days being above average with volume. Well, on Friday, we dropped to below average. Here's a chart that's been updated now, where sentiment, as far as investors' intelligence, is coming back down more into the neutral area after the last week was so negative. The Ulcer Index is still giving us a fairly high reading, meaning that there's fear in the market. We came down with the VIX on a closing basis when we're looking at the line chart. We also are coming back down to the moving averages with the bar chart. And with the update, volatility of the VIX is also decreasing, both with the bar chart and the line chart. The momentum of the VIX also continues to be downward, where it had been going up. These are not updated. I waited and waited, but these equity put call charts have not been updated yet. We're dropping down to the lower end of this band when we look at volatility risk premium, as we're seeing volatility dropping off now as the market's been going up, at least in Friday's session. We declined with this fear gauge, and we also declined to going a little bit sideways with this other fear gauge. And we're coming back up with our risk on to risk off ratio. That just means risk on is people are buying stocks. And that when this is going up, we're more risk on. When this is going down, we're more risk off. And we're kind of coming back up into the range that we've been in for 2024. If we stay in that range, I'll probably drop showing this chart. Here's consumer sentiment, where it ticked down just a little bit. I also plot the 2-year yield here, where rates have been going up. We're getting a little bit closer when we look at the spread between the two, but you can see from 2012 to just before the COVID plunge, these had a tendency to move in the same direction. There's still a wide spread, but we're seeing a little bit of them going in the same direction right now, but it's not real pronounced. Our advanced decline line studies, this is one of the areas that we've been latching on to give us hope. We actually were down on Friday based on price and volume. But new highs, new lows, we did see more new highs than new lows. We're turning up with our 5-period and 10-period. So this internal measure is still looking positive and showing improvement. We came down with the advanced decline ratio on an up day. This is another area that we've been latching on to for hope. Accumulation distribution is showing some improvement. We're just barely coming back above the moving average. So this is turning more positive if we can stay above the red line. We're also seeing an improvement here with the Chaikin money flow. We're still negative, but we're coming back up after getting extreme negative. The Chaikin oscillator has actually turned positive. And we were up with the cumulative NYSE advanced decline line, but we just barely ticked up a little bit with our regular NYSE advanced decline line, also barely ticked higher with this other NYSE advanced decline line. When we look at common stock based on price, just a little move up for the NYSE and a little bit of a move up looking at volume. Now, volume is looking a little better, where it's kind of breaking out a little bit, where price is kind of within a real short-term range right now. We're above zero when we look at the NYSE new highs minus the new lows, so that's positive for the broader market. And we turned down when we look at the cumulative S&P 500 based on price, and we also turned down a little bit based on volume on an up day. A very strange thing to happen. And this is an area that we've been watching for some potential hope that things are improving. We're just a little bit above the moving average when we look at our advanced decline line studies. This top chart is the NYSE common stock. We're right on the moving average with the S&P, a little bit above the moving average with the mid caps, and below the moving average, but bouncing up with the small caps. So we have some overhead resistance, and we're still battling with the 50-day moving average with the S&P 500 on the bottom. It's a little hard to see, but we dropped to below average with volume. We're coming back and starting to play with the 20-period moving averages again, where we were able to get above the exponential moving average, but now the simple moving average is acting as overhead resistance. Looking at our double and triple exponential moving average study based on 50 periods, this is looking a little more positive, where we were able to close above both the lines. If we can stay above them, these lines are flattening out and would actually start to turn back up. And here, I haven't shown this in a while. This is the 20-period simple moving average of the open, high, low, close, where we're coming back up into the mini rainbow. We need to break above that and see the mini rainbow turn up to turn back more positive. And we actually didn't really show any improvement. In fact, actually a little deterioration here. We were flat with the 20-period exponential moving average. We declined with the 50 and the 200 on an up day. Kind of strange. The force index is just looking a little more positive. It crossed back above zero. And we're going up with the short-term stochastic. That's looking more positive and crossing above the midpoint. We're showing some improvement with the intermediate term, and we're no longer extreme and starting to look better with the long-term stochastic. And we're right at the midpoint now with our standard deviations chart here. So the market's at an equilibrium point right now. Intermediate term, we're bouncing up, but still negative with the balance of power. We're turning back to, well, we're switching back over to a lighter shade of purple here. So that's more of a positive slant, the go, no-go system. We're right at the midpoint with our highest high versus lowest low values. The TTM squeeze is no longer extreme negative and the lighter shade of red. So that's on a momentum basis showing some improvement. And we look at our double and triple exponential moving average study based on 50 periods. Now we're bouncing up to this triple exponential moving average, which is providing overhead resistance. We keep an eye on the 50-period regular moving averages, where we're right in between. We're above the exponential moving average, which is blue, and we're below the simple moving average, which is in red. So we're kind of in no man's land right now. The ease of movement is still negative, but showing some improvement. The Erin indicator is still flatlining, but negative overall. We turned up just a little bit with the S&P McClellan oscillator, but we dropped below zero. So that's negative. So we're flattening out based on price, but we're still showing more of a positive reading when we look at this based on volume. And the NYSE McClellan oscillator just barely went above zero. So on a broader market basis, we're looking a little stronger according to this indicator. So we're just barely turning up with the summation index for the NYSE based on price and volume. And we're rolling over again. The Swenlin trading oscillator, it was just screaming higher, looking positive. We have an up day, and now it looks to be rolling over a little bit here. Momentum is still negative, where we're declining with the PMO, even though based on price and volume, we are showing an improvement, but we're still below the moving averages. We declined with the PMOs that are rising on an up day, but the buy signals are showing some improvement, and we're flattening out with the PMOs above zero. We've switched over to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. So we've had 3 dots underneath now. That's more positive. The slope oscillator is negative and extreme negative, but now starting to cross above its moving average. We're turning up with the MACD, but we're still below zero, and we're still below the moving average. So we're looking a little better with our short-term oscillators here. They're improving. We're seeing a little bit of an improvement with the MACD, the PMO, and the PPO, but are still below their moving averages, or we're still declining with our longer term oscillators, the tricks and the KST. Excuse me. And we're kind of fighting the battle of spaghetti here as we go into these moving averages, as some of them provide some support, some of them provide resistance. And we're just a little bit more positive now, barely above 50 with the bullish percent index. This is more positive. But on an up day like we saw, we would like to see a stronger reading than what is being shown right here. We actually ticked down a little bit with the NYSE bullish percent index, but we're still above 50. And we are seeing an improvement here. The NASDAQ 100 bullish percent index, it's no longer extreme negative and bouncing up out of that. It's still negative because we're below 50, but it is showing some improvement. And we're still negative with the money flow. We're actually turning positive with the ultimate oscillator. The vortex, the red line is coming down, but it's still on top. So we're still negative there. And with our RSI 14, we're just barely coming back up to the 50 level, where the RSI 9 is starting to cross above 50. So this is showing some improvement. On balance volume is still negative since we're below the moving average. And with our stocks inside the S&P above their 20-period moving averages, this showed some improvement after being extreme negative. But when you look at the 50 period, not that much. We're still below 50 altogether. And we're pretty much sideways with the 100 period, and we actually declined with the 200 period. So that's a little discouraging for right now. The copy curve is improving, but continues to be negative. The Sean trend meter is showing some improvement. The Ichimoku cloud, which it does look like it provided us some support. Now we could lose that if we really turn and start to go down. But for the time being, it looked like we were able to bounce up off of that, which was pretty much corresponding with the 100-period moving average for the S&P 500. We're looking more positive with the Heiken Ashi, and we're turning back more positive with the Kegi. We turned black and we're pointing up, where the Renko chart is still negative, but the 3-line break is turning back and looking more positive now. And here's this 5110 to 5111 level. We're just a little bit below it. We tried to get above it in Friday's session, but we were not able to recapture that. So now this still may provide some overhead resistance. But we're still looking good in the long term. Even though we declined with our 150 and 200, we're still looking pretty extreme with those readings. And we're showing some improvement here in the short term with the S&P based on the trend, but we're still negative in the short term with the other indexes. We're still negative in the short and intermediate term with the small caps. And we're still negative based on price when we look at bonds. No change here in the decision point scorecard. And we saw an awful lot of blue, especially for the NASDAQ. And then the S&P got above 5,100, and the NASDAQ was clearing some round numbers here. And the tech sector saw a bullish percent index cross above 30 after it had been extreme negative. We had come down and dropped below 20, then we came above that. Now we're crossing back above 30. The materials, which tends to be a little more defensive, it actually crossed below 50 where it had crossed back above it. The equal weight, not really seeing a big difference here. The mega caps really outperformed on Friday. So we're seeing this ratio going up, but we're just chopping more or less sideways now when we look at the S&P and compared to the equal weight S&P. And the Dow, it held up okay. It was up 0.4%. We're still above this pivot level, but we're still below the 50-day moving average. We continue to be neutral with the diamonds, with the Elders Impulse system. And we are seeing some improvement here. We were up over 2% with the NASDAQ. So we're kind of coming up into some resistance. And we also were up 1.5% with the NASDAQ 100. But we have some overhead resistance to deal with. And I know in these charts, it's a little bit hard to see because of all these other pivot points and numbers that are being calculated in here. We switched over to positive with the QQQs with the Elders Impulse system. The momentum for the NASDAQ 100 is still negative, but it is turning up. And the Qs did see a recent cross here with the 20 dropping below the 50. Now we're looking at this 20-period moving average as possibly being overhead resistance. And we just kind of came back up a little bit more into the range that the small caps have been in, but they've switched over to positive with the Elders Impulse system, and we're still above this resistance/support line. So we've been able to at least stay above that for the small caps. The momentum is showing some improvement, but has not quite crossed above its moving average yet. And the RSI is just a little bit below 50, but the longer term trend is still positive. The mid caps are still below their 50-day moving average. They were up 0.29%, so we didn't see an awful lot of strength there. But they have switched over to positive with the Elders Impulse system for the mid caps. Apple ended up being down 0.35% and is still below its 50-day moving average and still in a downtrend. Tesla, it was down 1.11% and still below its 50-day moving average and is still in a downtrend. NVIDIA was able to get back up. It was up over 6%, so it got above its 50-day moving average. Microsoft is kind of hitting its moving average here. It kind of came up to the 50-day moving average and then ended up coming back down slightly. Meta, which just got hammered on Thursday, it's showing a little bit of improvement, but up less than 0.5%. And Amazon also coming back up to its 50-day moving average and getting a little bit above it. Google setting an all-time high, and it broke out, and even though it gave up some of the gains after the open, it still ended up being up over 10%. The FANG index is coming right back up to its 50-day moving average, which could be acting as overhead resistance. The financial sector was actually down and is pretty much settling around its 50-day moving average. We're keeping an eye on this, the staples to tech ratio, where it is bouncing back down after hitting this moving average. If we're more positive on the market, we want to see this ratio going down. That means that tech will be outperforming staples. The dollar ended up being up, but it's still below the 106 level. Oil was up at $83.85. And looking at the US and comparing it with the rest of the world, the shorter term relationship is falling off, and we're also declining a little bit with the longer term correlation. We were up almost 1%, but we're still underneath the 50-period moving average with the total US stock ETF. We were down with the 10-year yield. We were up with the 10-year based on price. And then we saw some improvement here, but nothing all that strong with our growth to value ratios with the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. So we're seeing a little bit of an improvement here, but nothing really major to shift what we've been seeing lately with the large caps, mid caps, and small caps. We're still above 50 with our 10-day average of the S&P 500 highs minus the lows. So that's holding up for now. We're still above zero with our 19-day exponential moving average of the advanced decline ratio based on price and volume. And we're still looking positive with our 50-period exponential moving average of the new highs and new lows for the S&P. And on a broad market basis, we're improving, but we're still negative with our 5-period moving average of the highs minus the lows. And we ticked up a little bit with the S&P to utilities ratio, but overall, this has been coming down, which could put some pressure on the S&P. We want to see this turn and go back up with more conviction. We also came down here with staples to S&P. It ticked down a little bit, but it has been spiking out lately, spiking up. And we still have not generated a ZWAG NYSE breadth thrust. And we won't know until Monday, after Monday, for Tuesday's video, whether we're getting an extreme negative reading. We're still in that 10-day window, but that's going to close here pretty soon unless things turn much more positive. So what's our outlook for Monday? We're still negative in the short and intermediate term, but we are seeing signs of improvement. We're not going to have any economic reports on Monday, and we want to keep an eye on all the different geopolitical events. Here's the upcoming economic calendar where we're going to get the employment cost index on Tuesday, nothing on Monday. ISM is coming out on Wednesday, and then the Fed's going to make their announcement on Wednesday, and then there's going to be a press conference after that. And then on Friday, we get the employment report and ISM non-manufacturing on the same day. That could be real interesting, especially if they contradict each other. Here's the upcoming calendar with the forecasts and the previous readings. I don't have anything blocked out since there's nothing for Monday. Seasonally, we're positive across the board, and Monday tends to be a more positive day. So we're up across the board with the Dow, S&P, and NASDAQ. And we do see a little bit of positive seasonality during an election year here for the 21st trading day of the month. And we're starting to come back a little bit more up to the average here. I'm hoping that this chart will be updated here pretty soon to reflect more current prices. Also, it'd be nice if this chart was updated as we're coming a little bit more up to the green line. but we do tend to see some weakness in May. But that contradicts the chart I showed you earlier that Carson shows May ends up being pretty good. Monday is the most positive day of the week, and we're also finishing out the month of April, which tends to see some positive seasonality. And then after April, then we do see some weakness in May before we see things turn more positive going into the summer months. The first part of May tends to be negative, and then we're still in this positive window now, according to Tom Bowley's research. And then looking at May, where we do have a positive track record, but we don't see any real strong returns, according to the Stock Traders Almanac. So the warning signs, the McClellan oscillator is negative now. The bullish percent index for the NASDAQ 100 is still negative, but it is bouncing up. The chicken money flow is negative, but bouncing. The money flow index is negative. The Copic curve is negative, and the vortex, those still continue to be negative. Our oscillators are still negative. We're seeing some improvement with the slope oscillator, but it's not above its moving average yet. We're still below short, intermediate, and long-term support, and the momentum for the NASDAQ 100 is still negative. Positive signs. The NYSE McClellan oscillator has switched back to being just slightly positive. We're positive with the Swenlin trading oscillator, even though it did decline a bit on Friday. The parabolic SAR is positive. The bullish percent index for the S&P is above 50. And the Chaikin oscillator continues to be positive. The ultimate oscillator is positive. The long-term trend is still positive. The equity put call ratio, we don't know. But with the up day, you would think that it would continue to decline, which would be positive. And the financial sector is also positive. And this Newswag NSE breadth thrust, I never did go in and change that. We're still waiting to see if a signal is going to be generated there. So our conclusion, we're still negative in the short and intermediate term, but showing signs of improvement. We need to see more follow through. In the short term, we're negative but improving. We're also negative and below support in the intermediate term, but we are bouncing. We are seeing some improvements there. And in the long term, we still continue to be positive. Thank you. I hope you have a really good weekend. I'll be posting the weekend videos as I get a chance. Have a great weekend, and I will talk to you in the next video.